Preparing for FP&A Analyst at Lumen interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A mean to you, and what would an FP&A analyst contribute at Lumen? FP&A connects financial information with operating decisions. At Lumen, I would support budgets, forecasts, monthly reporting, and analysis across revenue, expenses, capital investment, and cash flow. I would validate data, investigate variances, and explain results clearly to business leaders. The analyst role is not just reporting history, it is identifying trends, risks, and opportunities early. I would aim to provide concise, decision-useful insight while understanding how operational drivers affect Lumen's financial performance. While answering, focus on planning, forecasting, performance analysis, business partnering, data quality, and translating financial results into decisions relevant to Lumen's connectivity, enterprise, and cost management priorities. Question 2. How would you build an annual budget for a Lumen business unit? I would begin with the prior year actuals and current forecast, then separate expenses and revenue into driver-based categories. For Lumen, drivers might include customer volumes, pricing, network costs, headcount, vendor contracts, and capital projects. I would meet business owners to challenge assumptions, build base, upside, and downside cases, and reconcile the submission to corporate targets. Finally, I would document assumptions, obtain approvals, and create monthly variance measures so the budget remains useful after approval. Make sure to cover the planning calendar, historical baseline, operational drivers, stakeholder input, revenue and expense assumptions, capital requirements, scenario analysis, review controls, and reconciliation to corporate targets. Question 3. Walk me through your approach to preparing a monthly forecast. I first load and validate actual results, then compare them with the prior forecast and budget. For the remaining months, I update assumptions using current run rates, known contracts, staffing plans, customer activity, and expected project timing. I discuss unusual movements with operational owners rather than blindly extrapolating history. I then quantify risks and opportunities, prepare an updated forecast, reconcile totals to the reporting system, and summarize the key changes for management. In your answer, talk about actuals to date, remaining period assumptions, run rate analysis, operational drivers, business owner discussions, risks and opportunities, version control, and explaining changes from the previous forecast. Question 4. How would you analyze a favorable or unfavorable budget variance? I would start by quantifying the variance and determining whether it is material. Then I would decompose it into volume, price, mix, timing, foreign exchange where relevant, and one-time items. For example, lower network expense could reflect delayed work rather than sustainable savings. I would validate the explanation with the responsible manager, assess whether the variance changes the full-year outlook, and communicate both the cause and recommended action. That turns variance reporting into forward-looking management insight. Be sure to mention magnitude, timing, price, volume, mix, one-time items, controllability, root cause investigation, business owner validation, forecast implications, and a clear recommendation rather than merely describing the variance. Question 5. Which KPIs would you monitor for Lumen's financial performance? I would monitor revenue by segment and product, customer additions and churn, average revenue per user where applicable, gross margin, adjusted EBITDA, operating expense, capital expenditures, and free cash flow. I would also track productivity measures such as cost per customer or network efficiency. The important point is linking outcomes to drivers. Declining revenue may reflect customer losses, pricing, or product mix. I would confirm KPI definitions and reconcile them to financial reporting before presenting trends. Focus on linking financial and operational metrics, including revenue growth, customer trends, churn, ARPU, adjusted EBITDA, cash flow, capital intensity, productivity, and segment-specific measures with clear definitions. Question 6. How do the income statement, balance sheet, and cash flow statement connect in an FP&A analysis? The income statement shows profitability, the balance sheet shows resources and obligations, and the cash flow statement explains the movement in cash. Net income affects equity, while depreciation reduces earnings without using current cash. Capital expenditures reduce cash and increase assets, then create future depreciation. Changes in receivables, payables, and other working capital also affect cash. In FP&A, connecting these statements helps assess whether earnings translate into liquidity and whether planned investments are affordable. While answering, explain net income, working capital, capital expenditures, depreciation, debt, and cash movements. Then connect the three statements to forecasting liquidity, investment capacity, and business performance. Question 7. Describe how you would forecast revenue for a telecommunications or connectivity business. I would build revenue from operational drivers rather than applying a simple growth percentage. I would analyze the starting customer base, gross additions, churn, retention, pricing changes, product mix, contract renewals, usage, and installation timing. For enterprise connectivity, backlog and contract implementation schedules would also matter. I would compare the driver-based result with historical seasonality and management guidance, investigate gaps, and document assumptions. This approach makes the forecast explainable and easier to update when conditions change. Make sure to cover customer volume, churn, additions, pricing, product mix, contract timing, usage, backlog, seasonality, and reconciliation between operational assumptions and reported revenue. Question 8. How would you forecast operating expenses and identify cost savings at Lumen? I would classify expenses by behavior and controllability, then forecast each category using appropriate drivers. Headcount would reflect employees, vacancies, compensation, and hiring timing. Vendor costs would reflect contracts, usage, renewals, and negotiated changes. For Lumen, I would separately track network, technology, selling, general, and transformation costs. I would validate savings with owners, confirm implementation dates, and avoid calling delayed spending a permanent reduction. Reported savings should ultimately appear in the forecast and cash outlook. In your answer, discuss fixed and variable costs, headcount, vendor contracts, network operations, run rate analysis, productivity initiatives, one-time costs, implementation timing, and distinguishing real savings from delayed spending. Question 9. Tell me about a time you improved a financial model or reporting process. In a previous role, a monthly expense report relied on manually combined spreadsheets and frequently produced inconsistent totals. I mapped the source data, standardized account and department fields, and built a controlled Excel model with Power Query refreshes and validation checks. I documented the process and trained users on reviewing exceptions. Reporting time fell from roughly 2 days to several hours, while unexplained variances declined materially. The experience taught me that automation is valuable only when ownership and controls are clear. Be sure to mention the original problem, root cause, tools used, controls added, stakeholder collaboration, measurable improvement, and how the solution improved accuracy, speed, transparency, or decision-making. Question 10. What Excel skills would you use most often in this role? I would use SUMIFs, XLOOKUP, index match, pivot tables, dynamic formulas, conditional logic, and charts for analysis and reporting. Power Query would help combine recurring source files and standardized data, while scenario tables could test assumptions. I would separate inputs, calculations, and outputs, use clear labels, add reconciliation checks, and protect key formulas. I also review totals independently because a technically sophisticated workbook can still produce a wrong answer if the source data or business logic is flawed. Focus on formulas, pivot tables, lookups, Power Query, scenario modeling, data validation, charts, error checks, and workbook organization, while emphasizing judgment and review rather than relying on automation alone. Question 11. How would you use SQL, Power BI, or other analytical tools in FP&A? I would use SQL to retrieve and join transaction, customer, cost center, or operational data, then validate record counts and totals against the general ledger or approved reports. Power BI could present trends, KPI drivers, and forecast versus actual views for business users. I would define measures carefully, avoid duplicate records, and document data sources and refresh timing. The objective is not a visually attractive dashboard, it is a trusted tool that helps managers understand performance and act quickly. While answering, explain how you would extract reliable data, join relevant tables, define metrics consistently, build useful visualizations, validate outputs against financial systems, and preserve governance and usability. Question 12. How would you explain a complex financial result to a non-finance executive? I would lead with the conclusion, quantify the impact, and explain the 2 or 3 most important drivers in operational language. For example, rather than saying expense was unfavorable because of mix, I would explain that higher use of an external vendor increased cost per installation. I would distinguish temporary timing from recurring economics, show the effect on the full-year forecast, and state the decision needed. I would keep supporting detail available without overwhelming the executive discussion. Make sure to cover starting with the business conclusion, using plain language, separating drivers from symptoms, quantifying material impacts, avoiding unnecessary detail, and clearly stating the action or decision required. Question 13. How would you perform a scenario or sensitivity analysis for Lumen? I would identify the assumptions with the greatest uncertainty and financial sensitivity, such as customer churn, pricing, revenue growth, headcount, vendor costs, or capital timing. I would create a base case and clearly defined upside and downside cases, ensuring assumptions flow through revenue, EBITDA, cash flow, and relevant balance sheet items. I would highlight the range of outcomes, identify threshold points, and recommend actions. Sensitivity analysis should help management prepare, not simply produce attractive tables. In your answer, discuss selecting key uncertain drivers, building base, upside, and downside cases, linking assumptions through the model, measuring financial effects, identifying thresholds, and presenting decisions and mitigations. Question 14. What is the difference between a forecast, a budget, and a long-range plan? A budget is an approved financial target for a defined period, while a forecast is the best current estimate of what will happen and should change as facts change. A long-range plan extends further into the future and links strategic choices to financial capacity. At Lumen, the budget might guide accountability, the monthly forecast might guide near-term decisions, and the long-range plan might support network investment and portfolio priorities. Keeping those purposes distinct prevents target setting from distorting expectations. Focus on purpose, time horizon, flexibility, ownership, strategic versus operational use, refresh frequency, and how actual results should influence each planning tool without confusing targets with expectations. Question 15. How would you evaluate a proposed capital expenditure project? I would first understand the strategic need, such as capacity, resilience, customer demand, or cost reduction. Then I would model upfront capital, implementation timing, incremental revenue or savings, operating costs, depreciation, working capital, and residual value where relevant. I would calculate NPV and IRR using appropriate assumptions, test downside cases, and compare alternatives. I would also assess execution and regulatory risks. After approval, I would track actual spend and benefits against the investment case. Be sure to mention strategic rationale, upfront investment, operating savings or revenue, timing, useful life, depreciation, cash flow, NPV, IRR, risks, alternatives, and post-investment performance tracking. Question 16. What would you do if actual results differed significantly from your forecast? I would not immediately overwrite the forecast. First, I would confirm the actual data, period cutoffs, classifications, and any unusual entries. Next, I would isolate the variance by driver and determine whether it came from a flawed assumption, timing, business execution, or a data issue. I would discuss the findings with the relevant owner, update the remaining period outlook, and communicate the revised impact clearly. Finally, I would document the lesson and improve the forecasting driver or control. In your answer, cover validating data, isolating the driver, determining whether the error is assumption-based or execution-based, correcting the forecast, communicating transparently, and improving the process to prevent recurrence. Question 17. How would you handle conflicting requests from business partners during a planning cycle? I would first clarify each stakeholder's objective, deadline, and decision impact. If requests conflict, I would apply consistent planning assumptions and show the financial trade-offs rather than choosing informally. For example, accelerating hiring may improve delivery capacity but increase near-term expense and cash needs. I would present options to the manager responsible for the decision, document the agreed approach, and communicate it consistently. Staying neutral, transparent, and responsive usually builds more trust than trying to satisfy every request separately. While answering, emphasize clarifying objectives, prioritizing materiality and deadlines, using consistent assumptions, facilitating trade-offs, escalating appropriately, documenting decisions, and maintaining collaborative relationships. Question 18. How would you ensure accuracy and control in recurring FP&A reporting? I would establish a repeatable process with controlled source files, defined ownership, standardized mappings, and documented deadlines. Before distribution, I would reconcile totals to the general ledger or approved system, compare period-over-period movements, test key formulas, and review unusual exceptions. I would maintain version control and preserve supporting schedules so results are auditable. If an error appeared, I would correct the output, explain the cause, and strengthen the control rather than relying on a manual workaround. Make sure to cover source validation, reconciliations, standardized definitions, review segregation, version control, exception reporting, documentation, auditability, and investigating errors rather than manually hiding them. Question 19. Why do you want to work at Lumen in FP&A? Lumen interests me because its connectivity business combines recurring customer economics, substantial infrastructure, and an ongoing focus on efficiency and transformation. That creates meaningful FP&A work, understanding revenue drivers, supporting investment choices, and helping leaders manage costs while serving enterprise customers. I am attracted to roles where analysis influences operations rather than remaining purely historical. My strengths in financial modeling, variance analysis, and communicating with non-finance partners would allow me to contribute while continuing to develop as a business-focused analyst. In your answer, connect Lumen's connectivity transformation, enterprise customers, operational complexity, financial discipline, and opportunity to support decisions with your analytical strengths and career goals. Question 20. What would you prioritize during your first 90 days as a Lumen FP&A analyst? During the first 30 days, I would learn Lumen's segments, key products, planning calendar, reporting definitions, systems, and major stakeholders. By 60 days, I would independently support recurring reporting, understand the main forecast drivers, and identify data or process risks. By 90 days, I would aim to deliver a practical improvement, such as automating a repetitive schedule or improving variance commentary. Throughout, I would prioritize accuracy, ask focused questions, and build credibility through dependable execution. Be sure to mention learning the business and systems, understanding reporting calendars and KPIs, building relationships, validating recurring processes, delivering an early improvement, and balancing curiosity with reliable execution. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.